All right, we're looking at the global wealth management case study on private markets. Let's look at question 1. What is the primary benefit of using a leveraged buyout structure for the acquisition of Technova systems by the Devereaux Investment Fund, DIF? We've got A, increased control over the acquired company, B, enhanced returns, or C, immediate improvement in operational efficiencies. Let's read a little bit here. Global Wealth Management Incorporated is a premier wealth management firm headquartered in New York. It specializes in offering tailored financial services to high net worth individuals across multiple jurisdictions. Recently, GWM was approached by a new client, the Devereaux family, which has significant holdings in private equity and real estate. The family's primary investment vehicle, the Devereaux Investment Fund, is a private equity fund focusing on buyout opportunities in the technology and healthcare sectors. The Devereaux family, led by patriarch Alexander Devereaux, established the DIF to diversify their wealth and capitalize on emerging market opportunities. Alexander's son, Michael, manages the fund. Michael has a background in venture capital and private equity, with a particular interest in transformative technology companies. Recently, DIF has focused on acquiring mature technology firms with strong growth potential, intending to restructure and eventually sell them for a substantial profit. Technova Systems. All right, looks like this is where what we want. DIF acquired Technova Systems, a mid-sized technology firm specializing in cloud computing solutions. The acquisition was structured as a leveraged buyout, with 70% of the purchase financed through debt. Technova had been struggling with operational efficiencies and lagging sales, but Michael believes that with proper restructuring, the company can be turned around. Okay, so the primary benefits of using an LBO, let's look back at these. There's not really a ton of information in the paragraph we need to answer this, but let's go look at these answers. So A, increased control over the acquired company. So the leverage buyout itself doesn't necessarily give us more control over the acquired company. If we used 100% debt or versus 100% equity of our own money, that doesn't really change our control over the acquired company. We're still acquiring the full company. So I don't think that answer seems right. B, enhanced returns. This is possibly our answer. More debt is going to lead to better returns in the future, hopefully, or it could lead to larger downside risk, but it can enhance our returns. And then let's look at C, immediate improvement in operational efficiencies. One, the structure of the buyout isn't going to lead to efficiencies. Again, kind of similar to A, how we buy the company doesn't necessarily lead to operational efficiencies. And we're going to have what's known as the J-curve effect, where improvement's going to take time. We might not be cash flow positive at first, but then over time we'll kind of hit that profitability. So we'll go with B, enhanced returns. Question 2, which performance metric would most accurately reflect the value created by the Devereaux Investment Fund's ongoing investment in MediHealth innovations? IRR, B, distributed to paid in, DPI, or C, residual value to paid in, RVPI. So let's take a look here. We're looking at the MediHealth innovations. So MediHealth Innovations, DIF also invested in MediHealth Innovations, a company developing advanced medical devices. The investment was part of a growth equity strategy, where DIF took a significant minority stake, providing capital for the company's expansion plans. MediHealth has a promising product pipeline, but requires substantial investment to bring its products to market. So keys here are we don't even have products to market. So they're invested in this company, but we don't have products to market. Therefore, it's not likely that we've paid out any distributions. So that kind of rules out the DPI calculation for looking at performance. DPI is going to measure our distributions, which we'll have paid none of. So there's nothing to really measure there. So then looking at internal rate of return and residual value. Internal rate of return is typically going to measure our realized return over time after kind of cash flows and everything have gone out. it doesn't necessarily isolate the unrealized returns, which is what we're kind of wanting to look at here. So I think we can go ahead and rule out A. And then for C, residual value to paid in, this is going to measure our unrealized gains. So we can kind of put a value on this promising product pipeline and then kind of use that as our performance measurement for what our RVPI will be. So it's kind of a measure of IOUs or distributions to be paid. So we'll go with C. Question 3. Which of the following best describes a key challenge faced by Michael Devereaux in managing the Devereaux Investment Fund's private equity investments? A. Managing liquidity risk due to the illiquid nature of private equity. That sounds correct, or sounds like it would be a key challenge. B. Ensuring high-frequency trading strategies are implemented effectively. Or C. Achieving immediate cash flow from newly acquired companies. So I don't think we need any more information here. We've already kind of established that it's a private equity company, and this seems to just kind of ask about key challenges of investing in private equity. So we can go ahead and rule out B right away. High frequency trading is not a private equity strategy. That's a hedge fund strategy, and there's no mention of using hedge funds anywhere in this anywhere in the reading. And then, like we said, managing liquidity risk is certainly something we need to account for. A lot of times with these private equity investments, you're locking it up in a fund for 5, 10, 15 years. And so if you have more immediate cash needs, you want to make sure you have liquidity in other parts of your portfolio. So A sounds like it's probably our answer. Let's make sure we can rule out C. Achieving immediate cash flow from newly acquired companies. I think we kind of mentioned this in one of the other questions, but private equity has what's called that J-curve effect, where immediately after acquiring the company, we're typically gonna, if this is profitability right here, we're typically not gonna have profitability for a little while we're kind of making those operational improvements. And then after those improvements have kind of taken place and we're improving things, that's when those returns are really gonna take off. So there's an understanding that they may not be immediate cash flow or huge returns. We're gonna have that J-curve and get those larger returns over time. So we will go with A. Question 4. What is the primary reason Michael Devereaux monitors metrics such as total value to paid in and residual value to paid in for Devereaux Investment Fund? Let's read a little bit more and then we'll come back to the answers. So I think we're on this last paragraph. The performance of DIF is measured using various private equity metrics, including internal rate of return and multiples such as TVPI and RVPI. Michael closely monitors these metrics to ensure that the fund meets its performance targets and aligns with the Devereaux family's long-term investment goals. Okay, so basically, why are we using these different types of metrics? Let's look at these answers. A, to assess the performance and potential future returns of the fund's investments. This sounds correct. TVPI is going to give us the overall value from distributions, plus it's going to give us that remaining value. So this helps us assess overall performance. And then RVPI is going to be more of a unrealized gains metric and tell us kind of what distributions or potential future returns could be realized. So A sounds like it could be our answer. Let's make sure we can rule out B and C. B, to evaluate the immediate liquidity needs of the fund. These metrics don't help us understand the timing of exits, so not really helpful for liquidity. You could maybe argue that if there's little RVPI left, maybe that there would be some liquidity coming up, but it really doesn't. Those are not going to be good liquidity metrics. And then C, to determine the valuation of each individual portfolio company. This is going to be incorrect too. These are looking at overall fund or portfolio, looking at the overall portfolio level, not necessarily individual company by company. So we'll stick with answer A here.